everybody. Welcome to this week's BizNews Finance Friday. I'm Jackie Cameron from BizNews, and with me today I've got Craig Gradidge, an award-winning financial planner. Welcome, Craig.
Hi, Jackie. It's good to be here today.
Thank you. And then we've also got Nilan, Morar, who is a Vice President of Trading at the Purple Group. So he's one of South Africa's top experts on trading the stock market. So welcome, Nilan.
Hi, thank you, Jackie. Nice to be here.
Thank you. So just before we take your questions, and please do pop your questions into the box. You'll see a little question mark on your screen. Before we start taking questions, I would just like to briefly ask Nilan to give a bit of an overview of what the Purple Group does and what he does for the Purple Group.
Sure. So it was a business that's close on 20 years old. There are three primary divisions. GT247, which is our sort of online derivatives trading offering. There's Emperor Asset Management, which is our in-house asset management offering. And then latest to add to the stable is Easy Equities, which is our cash equities business. And that business is about six years old, and probably the one that's grown the quickest out of the three. But we'll get into a bit of detail around what each business does and what products they offer, etc. As we go on, I'm sure.
Okay, thank you. And then we've got Craig, he recently won an award, his latest award. Craig is a certified financial planner, and he's been in the industry since the mid-1990s. Craig, can you tell us a bit about your award, and then also a bit about how you how you manage personal finance? What is your approach with your clients?
Yes, thank you, Jackie. Yeah, so we recently won the Intellidex People's Choice as Top Wealth Manager. So our clients gave feedback in that survey, and they're quite happy with how we interact with them, the advice that we give, with how we charge for our services and things like that. So it's the third time we've won it in the last 5 years, so we're quite proud of that. And we're a classical wealth manager, so we do everything from investment planning, retirement planning, risk planning, and estate planning. My speciality is on the investment and retirement planning side. And the way we do things is if we're going to make a recommendation, there has to be analysis that backs up the recommendation. So we don't go in with very firm views in terms of what we want to offer clients. We really need to get to understand the client first, because out of the analysis comes any kind of solution that we would put in front of that client. So that's the way we run business. So we do things. And that's GM Investments. We've been around since 2008. So we started out squarely in the middle of the last financial crisis. We got our license in October 2008, and just in time to build up a book for the current crisis.
And how are you finding your clients are coping with the whole COVID-19 situation? Are you finding more people are coming to you for guidance, or are they having to go and do their own thing because they're running out of money? What is the situation?
Yeah, so we have clients from across sectors in the country, across various sectors. So we had clients who were impacted in March. They were taking salary cuts in March already with the first lockdown, because the sector that they were in was very kind of directly and negatively impacted. So, as the crisis has unfolded, it started impacting on other clients. And also there's a kind of a compounding impact on various sectors. So some people expected we would have been out of this thing by August, September, and it looks like it's going to be another year, potentially even longer, of this pandemic that we're in. So it's been varied. We've had a few clients, some older clients, funny enough, looking to profiteer out of this by buying tocil at $30 and looking for other bargains in the market. So we've had a few clients who've jumped headfirst into the market in March and April, and they've done very well. I think what we had to do was contain some enthusiasm here and there, and just make sure that the risk management was sound. But we've also had clients where we've really had to restructure the plan and look at earlier drawdowns, bigger drawdowns, and things like that.
Thank you. And we've got some questions coming through now. And Hunty Kruger just says, greetings from Amanzimtoti. Greetings, Hunty. Hunty joins us every week, so nice to have you here. Nilan, how are you finding business? Are you finding that South Africans are also taking to day trading like ducks to water as they are in the US?
Yeah, so our business is primarily online, right? Sort of all three offerings that we have. The GT247 business, which is an online derivatives offering, offering CFDs across indices, currencies, commodities, a little bit of crypto, etc. That's been fairly stable. There has been an uptick in volumes that have come through, and certainly new accounts. But most notably from our side, about 6 years ago, we built a business called Easy Equities, which was meant to be a low-cost entry. I mean, the premise behind building the business was ultimately to address the barriers to entry for retail investors who want to start building an investment portfolio, directly in listed equity. And it's the brainchild of our CEO, Charles Savage, who basically, sat down and measured all these barriers to entry, and we said, well, that's the reason why when we started 6 years ago, there were approximately only 250,000 retail stockbroking accounts listed at the JSE. We've just gone past 500,000 accounts. This month, if I'm not mistaken, is when we breached through 500,000 equity accounts, and we've learned a lot. I mean, we anticipated about, and we had geared up for about 100% growth going into COVID, for the reasons that everybody else thought was possible as well. Largely around the fact that people are going to be at home, people are going to be looking to keep themselves occupied and get involved, and literally just have time on their hands. And coincidentally, we had something closer to 400% growth in terms of accounts and funded accounts and activity. So it's been an incredible journey. The last sort of 4 months has taught us a lot. We've learned more than we could have ever expected from data that we collect around activity and interaction with clients. Average returns, for example, from retail customers have beaten that of the index, the benchmark index, both across our US platform and our SA platform. So, I think for us it was really about creating the platform that allows retail South Africans the opportunity to invest in a low-cost environment without any minimums, no monthly fees, no platform fees, and just give them an opportunity. The other thing that's quite unique about that offering is that we fractionalize shares. So, if somebody has $100 this month and they want to buy a piece of Naspers, well, they can do that with us. So you buy 100 Rand worth of Naspers, and you continue doing that until effectively your position grows to the sum of one whole share. So yeah, there's lots of uniqueness about that offering. Coincidentally, both companies, I mean, GT247 last year won the Intellidex Top Stockbroker Award, and Easy Equities was second. Craig, those awards are coming up again soon, eh?
So we've got 2 award winners here. So we've got Shaman, who wants to know about Puminati shares. Nilan, would you like to give your assessment on what you think about that? Shaman wants to know, do we think that BEE shares are beneficial? And Craig, what do you think about this?
Yeah, I think let me bail Nilan out on that one. So Puminati is invested in MultiChoice South Africa. It trades on a dividend yield of at the moment, it's about historical dividend yield of about 16%. If you bought the share before the announcement, you would have gotten a dividend yield of over 22-23%. It's a fantastic cash generation machine, that MultiChoice business, MultiChoice South Africa. So it's not the whole MultiChoice group that you're buying into. And yeah, it trades like a utility in that you don't get much price growth out of it. So it tends to be a bit of price activity around the results, leading into the results. And then once the dividend is known, you see the share price go up about 15 to 20%. And then once the dividend is paid, it becomes ex-divi. And it kind of falls back to about 90 Rand a share. So, you know, you're buying it at 90 Rand a share, you're getting a 22 Rand dividend. It's a pretty decent return. It's a better than equity return just from divi. So if you hold it for 5 years, you should get all your money back. The outlook for MultiChoice South Africa, I think, is a bit tougher given COVID. So we should see people scaling down in terms of the packages they're using. And certainly MultiChoice is responding to those challenges. So it would be interesting to see what those responses are. The BE share that I think looks the most attractive at the moment is Yebo Yetu, which is invested in Vodacom, not Vodacom South Africa, which was the previous iteration of that deal. When that deal ended in 2018, the new scheme flipped up into Vodacom South Africa, Vodacom Limited. Currently, Vodacom, I think, trades at about 133 Rand a share. And Vodacom, yeah, the dividend, they increased the dividend by about 6%. So Yebo Yetu has a net asset value of about 75 Rand. If you apply a liquidity discount to that, you should get to a fair value of between 45 and 50 Rand. And it trades at 25, 26 Rand a share. So you're getting a fairly deep discount to fair value, and even deeper discount to net asset value. It's a funded scheme, and the cost of debt has come down quite dramatically. In fact, the cost of debt, the savings on interest works out to 5 Rand a share. And this is a share that trades at 20, 25, 26 bucks, you know, and then the dividend increased as well. So just COVID's been good to Yebo Yetu, actually, as a result of what's happened. Sasol, the Sasol BE ordinary shares at a fairly reasonable discount to value, trading at 80 bucks, and Sasol's at 144, 145, or whatever the case is. So a long-term investor would do well to get into that one at the moment. If I don't think that Sasol will go below 80 again.
Thank you. That's a very comprehensive response. Thank you. Wayne has a practical question. If using the Easy Equities platform, does the money need to come from an SAbased bank, or could one use your own offshore bank? And he says here, I don't want funds that have been legally transferred offshore stuck back in South Africa. Nilan, is that one that you can?
Yeah. So I'm assuming Wayne is looking at our US offering, and there are a few options. So you could, we've got approval to apply the 1 million discretionary allowance. So you could deposit rands and use our Easy FX facility to actually convert your rands into dollars into a USD account. Or alternatively, you could deliver USD to us in New York and load your US bank details, so that if ever you require those funds back, they go back into your US based bank account.
Thank you. And here's a related question from Frank. He says, we've been investing in US dollars and it has treated us very well, but to take money offshore at current levels, with the US dollar future very uncertain, and with the presidential elections coming up, we're not sure what to do. So I guess it's all about timing. Craig, what do you think?
Look, it depends if he's playing the long game or the short game. If he's playing the short game, timing's important. If you're playing the long game, the currency typically weakens 4 to 5% per annum over time. But at the moment, yeah, it's difficult. You know, the currency, I see it strengthened quite a bit this morning. The last time the gold price was at this level, the rand was a lot stronger. But it you know, with a lot of your borders still shut down for physical trade, it's unsurprising that the currency has remained relatively weak. Then there's also the challenge of all the stimulus that's taking place in the US. So there's certainly lots of dollars floating around the system, and that should cheapen the dollar over time. So yeah, perhaps he needs to consider another currency. Maybe look at euros, or get some diversification going on the currency front. But I think it's difficult to sell a cheap currency and buy expensive assets in the US at this stage. Doesn't make for a good investment thesis.
Thank you. What do you think, Nilan?
Yeah.
Do you agree with that?
Yeah, I agree. I agree with Craig. You know, I think attempts to try and time the currency for certainly in the short term is incredibly difficult, and most frequently, you know, people shout the loudest often closest to the end of a trend. So when we were at 19 Rand, everybody was calling the Rand up to 20 and 24. And you just knew that it had to turn, and this has happened so many times previously. So, you know, I would say don't try and time it. If and Craig is right, you know, you got to consider your horizon. If you're considering over time to build up an asset base in well, in US or anywhere for that matter, offshore, then do that over a period of time, because you know, the act of doing it, let's say every quarter, rather than looking for a lump sum move and waiting for a move down to 12, you might never get that move, and eventually you'll end up doing it at 19 out of panic, only to regret doing it at that point. So if you know, it likens itself to the discussion around saving. There's empirical evidence that it's extremely difficult to time the market. However, historical evidence suggests that there's been not much difference between somebody that has applied all metrics that they could to try and time a market and invest versus somebody doing it constantly over you know, at regular intervals over a long period. And so I would definitely consider that. There's a lot going on in that space as well. You know, we often, you know, I think the feature around diversification is going to feature a lot on your show, and I think it has in the past as well. And as Craig suggests, you know, look potentially for other currencies to look at. I mean, the USD is attractive because it's publicized, and you know, commodities like gold and oil, etc., are all priced in dollars. So it's easy. It's an easy point of reference, but there might be better value elsewhere. I know people have been looking at Aussie dollar recently as well, euro, but there's uncertainty around, well, there was uncertainty around Brexit for a long period of time on that. But again, you know, there's a lot happening. The system is flooded with free money. You get no interest rate return. In parts of Europe, it actually costs you to hold euros in a bank, which again leads to the discussion around whether or not we think assets are overpriced, you know, at the current level. I mean, if you're looking at US assets, if you make 2% in an annum, you've beaten cash deposits by 10 times, and so you get this exuberance that almost suggests that you have to do something with the money, you know, and that unfortunately comes at the expense of proper risk management and assessment, you know, the kind of evaluation that Craig and his team would do before getting involved in assets like.
Thank you very much. That's also very detailed responses there. Now, Tim says he has Sasol shares, and he says a percentage of it is tied up in Sadol Kanyisa. Should he sell the balance or wait out? He'd love to buy more shares. What do you think I should consider? He says, of course, that's the $1 million question. Where are we all going to find the next Sasol, I suppose? Nilan, would you like to answer that one first?
Yeah, you know, I think to answer that, you've kind of got to try and understand why Tim bought Sasol in the first place. What led to that decision? Was it a fundamental decision based on the subscription to the view that you think oil itself was undervalued? Was it a rand play? Was it a value proposition from the company, or like many people, bought it on the prospects of Lake Charles, which has been marred with delays, cost overruns along the way. Most recently, a brief interruption because of weather-related concerns. But all of that said, I think at these levels, if I own Sasol, I would hold on to them, and maybe with the view of looking to add into a bit of weakness. So I wouldn't be all in at these levels. If it does come back a bit, I'd be looking to add to Sasol. And again, that would be like a 3 to 5 year kind of view on it.
Thank you, Craig. What's your view on the Sasol question?
Yeah, look, Tim can't sell Khanyisa. Khanyisa doesn't trade, so he has to sit in there for a few more years. I think he needs to have a look at what weighting does Sasol make in his portfolio and what he's trying to achieve with his portfolio, and if it makes sense in terms of that analysis. If he's overexposed to Sasol, then just as a principle, he may want to diversify away from it. But if it's a reasonable weighting in his portfolio, he can't do anything about Khanyisa. Just hold on to the Sasols. Take a 3 to 5 year view, as Nilan said, and he could do quite well. The oil price seems to be holding up fairly well. If we get a vaccine sooner than expected, then perhaps air travel resumes a lot quicker than expected, and you see a pickup in the oil price. That will be good for Sasol. Hopefully the balance sheet repair process, they do better than expected on that front, then it could do well. So I think there's a bit of upside, and there's a potential for positive surprises as well. So I'm certainly holding on to mine.
Thank you. And Ismail says, the 5-year history of the JSE is a mess. How does one invest? Or is it better to hold on to cash? Nilan, what do you think? Is now a good time to invest in JSE stocks?
Again, I think you've got to be extremely selective at what you look at the moment. Cash has its place at times. I don't believe in a 3 or 4% money market kind of environment. Cash is your first call. Dividends of late have been fairly sparse. We've also seen many companies holding back dividends, not just reducing dividends. So that has to be considered. But again, I think there's got to be a more sort of macro evaluation around where to invest. I mean, there are pockets of I would imagine value across our local market. And again, it's not to say that if you buy now, the market is not going to go lower from now. I mean, it probably will. However, the idea is about how you manage your risk on that entry. The other concept that that we mentioned features already. Try and diversify out a bit. We're seeing great growth and great interest in ETFs, and the benefits. I mean, all these things offer cons as well, but the benefits is largely comes with the fact that you're not singularly exposed to a specific company or the management of the company or the related products of that company, for that matter. It gives you a cheap opportunity to diversify geographically as well as by underlying asset class, if you like, or a market segment, if you like. So that's something you should consider. So say, for example, and it's something that I'm watching at the moment. I don't think we're quite there yet, but I think we will get there on the financials. I mean, the banks have come back quite a bit. One can completely understand why. During periods of economic distress, certainly banks are under pressure. the threats of bad debts increase over periods, and you can understand why, why they've had such a hard time recently. And certainly, if you look at the price action on financials, they've come off quite a lot. Financials, broadly speaking, would include insurers. These are typically the things that are cancelled. Insurance policies are cancelled during times of distress as well. So you can understand why those are behaving the way they are. I am keeping a left eyeball on it, and the idea behind that is to kind of ease my way into a position when I think that they've exhausted this move down. But instead of choosing whether I buy, for example, a Standard Bank or a Nedbank or a Capitec or a ABSA, one could look at the Satrix Fini, for example, which has a blend of these underlying financial institutions. And so that's something else to consider, is just try and blend that risk so that there is diversification, even if you buy a single instrument, that you're not exposed to a single company or its management team.
So Mandar asks, if anyone does not have knowledge of the stock market and is interested to earn money through this, is this the type of investment that can help? Do you think that people with no knowledge of the stock market should be investing directly in shares, Nilan?
I think there's a process of there's an educative process that one has to go through. You have to understand what you're doing. After all, it is your money, and history has proven that even people who do know what they're doing and do have experience in financial markets do get it wrong. Steinhoff is a great example. Many fund managers were exposed to the Steinhoff debacle. Steinhoff looked cheap at 60 Rand. On the move down, and so again, it doesn't guarantee you having that experience or that knowledge doesn't guarantee you that you'd make money. Again, you have to measure what are you trying to get out of it. I mean, I heard earning an income or earning from the stock market in the question. Companies can stop paying dividends. If cash flows are tight. These are not things that are guaranteed. So typically, somebody looking for an income stream would look at almost fixed income securities where you can predict your cash flows and live off those. So I would suggest that attend webinars like this, up the knowledge base. There's plenty of information on YouTube, and then to do a full analysis on your needs, speak to somebody like Craig, because that's what they do. In terms of analyzing where you are in your life cycle, what it is that you require. Is it growth? Is it value? Do you need an income from your investment? What's your horizon? These are all things that will come up through discussion and through evaluation, and then ultimately be married to a product that best delivers in terms of what that person requires.
Thank you. Here's a question from Peter for Craig. Peter wants to know, with MTN's restructuring, does Craig think that Vodacom will be picking up the slack beneficially? Don't know if that's a question that you want to answer.
Yeah, it's a tough one. Well, I certainly hope so, because I'm heavily invested in Yebo Yetu, which is Vodacom. I mean, yeah, Vodacom's BEE deal. Look, I think MTN does look cheaper. They've been through the mills with their kind of risky domiciles, Nigeria, Middle East, and the challenges that they faced in some of those places. So, yeah, new management. I think Ralph is certainly a capable manager, and somebody described by the market as a safe pair of hands. So, yeah, look, I would invest in both, and in fact, I am invested in both. That way, I own 95% of the market. So you don't always have to choose. These are not soccer teams, they're not religions. You don't have to take one side. If you like the sector and it's cheap and you think you can make money out of it, I would certainly look at both. I've got Vodacom via the Yebo Yetu scheme, and I've got MTN directly because MTN was a whole lot cheaper a few months ago when I bought into it. And yeah, look, I think if they exit some of their positions at good prices, then I think certainly there's some upside to be seen on the MTN stock. So yeah.
Thank you.
Both.
Okay, good.
Yeah.
Good advice. Nilan, do you have anything to add to that?
No, I agree. Look at the sector holistically, and again diversify within the sector. I mean, it leads to the point that we were mentioning earlier. If you like, for example, staples or financials, I mean, you don't have to go and choose one. In fact, the risk profile of that position is much greater than if you had three, for example, in your portfolio.
Thank you. Now, here's a question from Andrew, and this is a question that we get asked quite often. He says, I have SA shares. Would I be better off selling them and buying foreign shares? I will lose money on some of the sale of the SA shares. Is it worth holding on to SA shares in the hope of a comeback? He says he mainly has blue chip and property shares. Who would like to take that question? Craig, do you think it's a good idea to sell? Nilan, what do you think?
So,
It's all
thanks,
about
Craig.
timing, I guess.
Yeah, because you helped me earlier, I'll pick this one up. So property has, yeah, you're right, Jackie. It is about timing. When were these positions put on? Relatively, how far away are we from the entry? If we're going to say we 70% down on some of these property positions, then there's no point selling them, to my view at least. So again, it is about timing. Property has been under pressure. I think that the move of all of us, migrating our office space to our home offices, has certainly highlighted many questions around the property sector, and property prices. Shares of property companies have responded that way. We've seen drastic moves lower, and people are questioning whether office parks are actually still a thing of the future. Do they get reoccupied? Do tenants come back? Are they able to sign leases going forward, etc.? And likewise, I mean, there were many questions around things like shopping malls, etc. as well, because on the one side of the equation, you take a lease at a mall, almost for the safety of the foot traffic that goes through the mall. So somebody might not be going directly to your shop, but they might stop in your shop because they're going to the shop next door, and that's what you pay for. However, all of us, well, many of us at least, have not gone to malls recently, and whilst you have that equation, you still have the expense side on the lease and the rent and the staff and stock, etc. So the equation becomes unbalanced, literally because of COVID, and that's been the move in property. I think it is healthy to have some exposure offshore in any event, whether it's fresh capital that this client is putting in, or whether it is taking off some of the profits of the profitable positions and taking that offshore for diversification. Leading from that, I suppose the next question is going to be, well, what do you buy offshore? And again, I mean, you look at these markets like the Nasdaq hitting record highs and trading above the highs that we were pre-COVID, and you ask yourself, from a valuation perspective, does it make sense? Is it sustainable? We've seen some bizarre moves this year. Companies that have filed for bankruptcy and the share price doubles. That does not make theoretical sense. And the fear there is that you get caught up in this hype, with the inability to assess the risk that moves like that present, simply because by the time you get to that stage, you've taken the bite around certainly trading dollar rand at 17, plus a 2 or 3% haircut on the fees that are associated in doing that, and you try to recover that up, quite quickly. So you've got to be careful in terms of that decision as well. So I think it's healthy to have a globally diversified portfolio, And so if you're only in SA, I would certainly look to externalize some of that.
Thank you. And now Gregory wants to know, he says he's been looking at the JSE All Share bobbing up and down. When is the next stock market crash? Craig?
Yeah, I was just checking the
Craig,
watch.
we've got half an hour, man.
Yeah, look, I mean, there's a big difference between the JSE and Naspers. And, you know, if you look at SA Incorporated is dirt cheap. It's gone nowhere for many years. And, you know, so to see any kind of collapse on some of your small caps and your SA Incorporated shares, you know, those would become incredibly cheap if that did happen. So it would depend on what the driver behind the crash is. If it's something local, typically our crashes we import them from the rest of the world. So a global financial crash or what's the thing, Asian crisis or a tech bubble bursting or terrorist attacks. Typically, when we have these big crashes in the market, it comes from offshore. But we've had kind of a slow bleed in terms of South Africa with 9 wasted years. I don't know, it's 11 or 12 wasted years now. And your SA Incorporated stocks are they're cheap. Some would say for good reason. But I think if we did have an external shock of some sort and they were further driven down, I'd be looking to buy in at that point. When that will happen I have no idea, which is why the principle of diversification is so important. And it's why you should have cash in your portfolio at the moment, because, you know, while from a return perspective, cash is giving you very little, it does protect your capital, and it gives you that dry powder to get back into the market when you have some kind of market crash. And you have Sasol going to 21 Rand a share and things like that. So I don't know when. I think South Africa's fiscal position has deteriorated quite poorly. So there's perhaps some long-term risk there. America is looking expensive. The tech sector is, you know, markets can be irrational longer than investors can stay solvent, I think is the quote. And so people have been taking a bath on shares like Tesla and a couple of the others. So yeah, it's a tough question. There's no easy answer. I think if you apply the principles and apply the principle of diversification, if you don't buy expensive shares, you know, I think you'll do well over time. But I don't think anyone can give you an answer in terms of when the next crash will be.
Thank you. I have a hunch that Nilan does spend some time trying to figure this out, because you spend a lot of time looking at charts, don't you, Nilan? What are your charts telling you about where we are in relation to another crash, possibly?
So yes, we do, and that's on the trading side of the business, you know. So it's shorter term by nature. I mean, the one thing I would add, you know, to what Craig has just shared with us is the fact that there's a lot of free money floating around, and you know that serves as a backstop. Quite often it's almost like there's a guaranteed stop in this market where you know you come off 2 or 3 or 4% and you just have to buy it because you know money is going to be thrown at it. And you know that happens you know time and time again. There are certainly some sectors and some indices that are looking too far stretched, and you know to my mind when looking at the charts, I'm absolutely stunned at not only the magnitude of this recovery. We've had such a March lows, but the pace at which it's happened. You know, I'm finding it very hard to justify in my mind any way how people can say that we're in a much better place now economically than we were 6 months ago. And asset prices are telling us that we are, because they're rallying to new highs. But on the street, I mean, just about everybody I speak to is either themselves or knows of a close business that has closed down, or people unemployed, or people laid off. And that's scary, because you know, the market ultimately ought to be a reflection of that. So whilst I also agree that you know, I think these bigger moves lower are driven by exogenous things, or assisted by exogenous things, or started by them. I do think that, you know, it would be an event that is more globally inclined, that we will catch on to, that leads us lower. There's absolutely no way of calling a top or calling a bottom. No one has the foresight. I mean, there are lots of systems and there are lots of claims around what one can use, you know, and there's a multitude of analysis that one can do. But again, you could still be wrong for a month or two or a year, applying just about every piece of analysis that you know that you have. Technically, for example, I mean, there were some hints on tocil, and again, you know, that's the most basic of technical analysis, is looking at support and resistance, but again, not highlighting what the magnitude of that sell-off would have been. Likewise with Steinhoff, and you know, you got to remember also that sometimes these could be fake moves or very temporary moves, you know, a day or two, and that would change the dynamic, because if it were a short-term move, let's say over a short-term misinterpreted news article or headline, that would present a great buying opportunity. So there's a lot of interpretation risk that comes with that as well. But it is absolutely impossible to pinpoint the absolute top in terms of level or time.
Thank you. Now, William wants to know, why on earth did PSG plunge this week by more than 70%? Craig,
So that was,
yeah, the unbundled Capitec. It's a simple answer. So there was an unbundling as corporate activity. And yeah, so if William was holding PSG, I think it's the 1st or the 2nd of September, you should see 14 Capitecs for every 100 PSGs that he held in his account, for which he didn't pay a cent, and therefore the value will come back. And I see PSG is up like 20% or something since that unbundling. So yeah, it's just simply corporate activity.
Thank you. And then somebody wants to know, what people often talk about selling in September. What are your views on that? Is there anything in the seasonality of the stock market?
Yeah, sell in May and go away, things like that. Yeah, it's not important that my investment strategy rhymes. I think it's important that you pay attention to the fundamentals of what's happening. Yeah, I think typically people look at historical moves. I think it used to be October that was the scary month, not September. So unless there's a bit of time inflation and people are trying to preempt the October move and start selling out in September. But yeah, you know, I don't know how many Septembers were preempted by a pandemic, or you know, just the kind of stimulus that we're seeing in the markets and what's happening at the moment. So no, certainly I wouldn't look at kind of rhyming strategies. They generally, you know, there's some randomness in terms of how effective they are.
Thank you. Now, Mary Jane says, how important are environmental issues when it comes to investing? She says, what about impact investing? And then she also says tocil is a no-go as far as she's concerned. So she didn't invest in tocil. But what do you think? Do you think we should be staying away from companies that are the bad boys of the corporate world? Nilan, what do you think? What are your charts telling you?
You know, I think there's a growing view that companies need to become more responsible. We are all enlightened and awakened to the fact of effects of global warming and deeper reaching economic activities that lead to potentially environmental disasters and the impact of this on livelihoods, sustainabilities, etc. So I think there needs to be a consideration for it. I think that individual companies will be pressured to adapt or change, to become more accommodating towards it. I think it's just going to grow from here on in. I must admit, over lockdown, I mean, you feel the difference over lockdown with the limited amount of traffic around. The air has been much cleaner. Many more birds are heard in the mornings, and it's made a difference. And these are just subtle things, that you pick up on. I'm personally, I'm not as sure if I'm ready to be as drastic as cut out certain companies entirely. However, would pay more attention to what the company's plans are towards environmental interaction.
Craig, what do you think about socially responsible investing? Does it actually produce good returns?
It can. I think it's a long-term game. Unfortunately, management still seems to be incentivized on more short-term metrics. So their focus would be on this year's profits, next year's profits, and issues like the environment and kind of the broader society are not always baked into those incentives. So I think some companies have demonstrated an ability to profit from being a bit more responsible and kind of taking those ESG and triple bottom line factors into account, where they're not only incentivized on profit, but also on the impact that they have on the broader society. I was trying to think, I think it was Unilever, where one of the I think it was the incumbent CEO who was speaking more kind of passionately about ESG factors and kind of baking that into how they run the business and things like that. And the market kind of punished him for talking about ESG, and they were interested in how he was going to expand margins over the next quarter and things like that. But he stuck to his guns. I think one of the products that came from that whole process was a stay soft product where you only needed one rinse cycle, whereas previously you needed 2 or 3 to get the chemicals out. And so we're kind of just demonstrating that if you kind of think deeply about these issues, that they can actually be good for business. But whether or not you can find enough companies around that can deliver return on capital, because ultimately that's what investors want, over the investment horizon that the investor has, and deliver to those ESG and sustainable kind of growth targets and your triple bottom line. I think that's the big investment challenge. We've seen a few companies go there locally, and so far early evidence is the returns out of those funds hasn't been the best. So ultimately capital will go where it gets the best return. So I think this is certainly a longer term game. But the more investors talk about it and the more companies think a bit more deeply about these issues, I think we'll get to a point where that's no longer a trade-off between profit and kind of sustainability.
Thank you. Well, Marianne, I hope that answers your question. So as we come to the end of our webinar, we've got time for one more question. And this is a question that's been asked by quite a few people. What will the US election do to the market? So with that, how do you plan for this? So Craig, how would you be realigning your portfolio or your investments with a view to what might happen in the US?
No, I wouldn't be realigning my portfolios because the US is having an election. They have an election every 4 years. They've been doing that for hundreds of years, and you know, sometimes there's a short-term move in the market because perhaps policy of the incoming is quite different. And I suppose a lot of investors are worried about the fact that Biden is talking increased tax, which is the responsible thing. When I think your expected budget deficit is running into double digits, it certainly would be responsible to start looking at raising taxes and trying to counter the effects of a weak fiscal position. Yeah, I wouldn't change tax purely because of the election. I have no idea who's going to win. I certainly hope it will be Biden. That's just a kind of a unaffected. I don't have to deal with the ramifications of living in the US and having Trump for another 4 years, or not having him around again. He is entertaining, but whether he's making the right decisions for that economy, and you know, just the lack of leadership through COVID kind of speaks volumes. So I certainly wouldn't look at any big changes. I may just keep some cash handy if there's a bit of short-term turbulence, but I certainly wouldn't be making wholesale changes on the back of an election outcome.
Thank you. Nilan, traders like volatility, don't they? Isn't this a good opportunity to make some money now?
Yeah, absolutely. I mean, they thrive during periods of high volatility and high uncertainty. You know, I agree that from an investment perspective, in terms of exposure, no need to go and sell out half your policies and half your investments and wait. I mean, but definitely keep some cash available for volatility. I mean, you know, the currencies could effectively present some opportunity from a trading perspective. Dual listeds could, as a result of their exposure and the impact that currency moves have on that. So in the short term, then yes, you know, you could possibly get quite a few trading opportunities, but absolutely no point in terms of changing your strategy or lightening up completely in anticipation of I suspect everybody's going to be responsive anyway post a surprise outcome. Yeah, from a trading perspective, we'll definitely see some activity, certainly in currency space. I mean, that tends to move the quickest. You know, currency markets have the deepest liquidity in the world, and they operate 24 hours pretty much. So yeah, that's where you'll see primarily the initial responses.
Great. Well, thank you very much for taking the time to answer all these questions for our webinar attendees. And thank you to all our attendees for joining and for your questions. Many people have asked for Nilan and Craig's details. So if you want to send me an email, there's my email address. And thank you very much. And we'll see you same time next week.
Thank you.
Thank you.